Alright, welcome to topic 10A, Consolidations, under Financial Reporting Unit. Under ASB 10, that is Consolidated Financial Statements, the group of companies are required to consolidate their financial statements. The purpose is to provide consolidated financial statements to show the result of financial position of a group as if it is operating as a single economic entity. So with regards to this, the consolidated financial statements, including statement of financial profit or loss and other comprehensive income, will show the result derived from operations with parties external to the group of entities. Effects of all intragroup transactions are eliminated, as they have seen or they will be seen as operating as a single economic entity. So those intracompany groups will be eliminated. It should be noted that these eliminations are only applied or can be seen on consolidated worksheet and consolidated financial statements, which means that it should not affect their separate financial statements. So if parent company have their own financial statements, the subsidiary will have their own financial statements. This elimination entries should not affect those reports. So in consolidated statement of financial position, it will include all assets controlled by economic entity and all liabilities owed to parties outside of economic entity. So again, when we talk about economic entity, it will be all subsidiaries and parent statements. So they will be seen as one only. Liabilities owing to organization within the group or the economic entity will be eliminated. Definition of consolidated financial statements under ASB 10 says the financial statements of a group in which the assets, liabilities, equity, income, expenses, and cash flows of the parent and its subsidiaries are presented as those of a single economic entity. This is the model to show how the economic entity works, and with this illustration you can see that there are two entities involved, company A, which is the parent, and company B, which is subsidiary. These are two separate legal entities, but for consolidation purposes they will be seen as a single economic entity. So any transaction between these two, or we call it intragroup transaction, should be eliminated in preparing consolidated financial report. But again, it should not affect their separate financial statements. Consolidated financial statements include a consolidated statement of comprehensive income, consolidated statement of financial position, consolidated statement of changes in equity, and consolidated cash flow statement. So we will not discuss it here. Consolidated financial statements combine like items of assets, liabilities, equity, income, and cash flow or flows of the parent with those of its subsidiaries. Accounts of individual entities are not affected, as emphasized in previous presentation. Now, before we go on and prepare consolidated financial statements, we will discuss different concepts of consolidation. The first one is what we call entity concept, which is the one adopted by ASB, wherein all assets and liabilities of the parent and subsidiaries are included. And then there will be provisions or separate item for non-controlling interest. This one is treated as an equity. Okay, so which means it will appear on the equity section of the consolidated financial statements. The second one is what we call proprietary concept. They're assets and liabilities of the parent entity, and only a proportionate share of subsidiaries' assets and liabilities will be included. What does it mean? For example, if the parent only holds around 90% of the subsidiary's controlling interest, in that case, the parent will consolidate the report only 90% of the subsidiary's assets and liabilities will be included. And in this case, non-controlling interest will not be included. And the third one is the parent entity concept, where it is the same with the entity concept. The difference will be not controlling interest will be treated as a liability. Okay, let's do the accounting for consolidation. Okay, the first step of the consolidation process is to substitute the assets and liabilities of the subsidiary for the parent's investment account. The investment account under parent's book is the representative of the amount which is paid to acquire the controlling interest of the subsidiary. The investment account in the parent will be eliminated in full against the pre-acquisition equity of the subsidiary. This is quite important to note because when you're doing consolidation for many years, okay, you still have to come back to the pre-acquisition equity when you're doing the elimination. Where the net assets do not equal the fair value of the purchase consideration, this will lead to a difference on consolidation. It will have either goodwill or gain on bargain purchase. So later we'll discuss those. The consolidation journal entry to eliminate the pre-acquisition shareholders' equity of the subsidiary will be like this. So debit share capital, debit retained earnings, debit goodwill, and then credit investment in subsidiary. So for example, if the name of the company or the subsidiary will be ABC, so you can say investment in ABC subsidiary. Note that this basic journal entry represents the equality of investment in subsidiary and the total shareholders fund. So which means if there will be difference, it may result to goodwill or gain. This is a sample of a consolidation. Okay, so let's assume that parent limited acquires all the issued capital of subsidiary limited for a cash payment of $500,000. Okay, so the statement goes like this. So these are separate statements from subsidiary and from parent. So what we are planning to do here, as stated under the entity concept approach of consolidation, is to add assets and liabilities. Straightforward. The only thing is for us to eliminate the shareholders' equity of the subsidiary at the pre-acquisition date and investment in subsidiary, which is under the parent's accounting books. Now, let us determine goodwill. Okay, so let's assume, okay, that the assets of subsidiary limited are fairly valued. So which means we don't need to adjust the books of the subsidiary. Then let's determine whether there will be goodwill on acquisition. Okay, so we have a fair value of purchase consideration. That this is the amount that we paid during the acquisition date, and then less fair value of identifiable net assets. If you can recall our discussion in intangibles, we had covered this. The difference is when we had discussed goodwill or the intangibles under the subtopic goodwill, we are talking about assets and liabilities. But here, in consolidation, this fair value of identifiable net asset will be assumed to be, especially on the consolidation part, will be assumed as the equity. So the difference between these two, if fair value of purchase consideration is greater than fair value of identifiable assets and liabilities assumed, then the result will be goodwill. If the opposite happens, then that will be gain. So when you do the journal or consolidation entry, we have debit share capital, debit retained earnings, debit goodwill. These items you can see on the previous slides, the parent and subsidiary books, and then credit investment in subsidiary. Notice the difference, goodwill is debited. If it is a gain on bargain purchase, that should be on the credit side. Again, take note, it will be only posted in consolidated journal and consolidated worksheet, and it should not affect the separate financial statements. Then take note that consolidation entries need to repeat adjustments every year, especially of course if you are consolidating the report. Now if you look into the consolidation worksheet, you will see here that we debited goodwill, shareholders equity, which includes share capital and retained earnings of the subsidiary, and then we credited investment in subsidiary, which is under the parent's book. Now if you move at the right, you will see cash, we added 10 and then 5, and then accounts receivable, and so on and so forth. Now when you go to investment in subsidiary limited, we have a debit on parent's book, and then we credited it in the elimination adjustment. So of course in accounting rule, different sign, okay, it may negate or eliminate. In this case, it was eliminated. Both 500 here, or these amounts are in thousands. Then the amount in consolidated statement will be 0. Then we will see current liabilities down below. Okay, we have accounts payable 60 for parent, and then subsidiary 30. Then you have added. Both of them will be assumed, of course, in credit side. So you can see both. If you add these items, you will have 90, and so on. When it comes to share capital, you see that parents amount, that there will be amount, of course again all amounts that I'm mentioning will be in thousands of dollars. Here we have thousands here, and then subsidiary 200. You debited 200 in the elimination adjustment. We know that the normal balance or normal side of subsidiary is on the credit side, so 200. When you debit it, then it will result to or elimination of the credit side on subsidiary. So we have on the consolidated statement 1,000, okay, or 1 million. And the retained earnings, same approach, eliminate 280, then we have 200. Then afterwards, try to get the balance, of course, and you will have this result. Now, if in the sake of discussion about gain on bargain purchase, it usually happens when the acquirer or the parent acquires the subsidiary at a lower price. So meaning they actually have gain. And the gain on bargain purchase will be treated as part of the profit or loss. So this is the example of elimination entry. So you have to debit, of course, share capital, retained earnings. And then in the credit side, we have investment in subsidiary. Notice in the previous illustration, goodwill is on the debit side, while gain here will be on the credit side. Now, in case where subsidiaries assets are not recorded at fair value, okay, it is obvious that we have to revalue the accounts before we do the elimination. So the first thing to do is, of course, adjust. Now, question is, when will be the adjustments be done? Should it be before or after the acquisition or during the acquisition? So ASB 3 stipulates either all the non-current assets of the subsidiaries or the subsidiary are revalued at fair values in the accounting records of the subsidiary and in consolidation before consolidation worksheet before consolidation. Then we would eliminate the investment in subsidiary against the pre-acquisition shareholders funds of the subsidiary. So the pro forma journal entry will be like this. Okay, so debit non-current asset, credit revaluation surplus, and then credit deferred tax liability. To eliminate, debit share capital, debit retained earnings, debit revaluation surplus, the same amount that you can see on top, debit goodwill, and then credit investment in subsidiary. Consolidation after the date of acquisition, pre-acquisition equity of the subsidiary are eliminated on consolidation. And then take note of this. Post-acquisition earnings are considered to be part of the earnings of the economic entity. So, which means the post-acquisition should not totally be eliminated, only the pre-acquisition ones. Consolidated retained earnings will include the retained earnings of the parent together with the accumulated earnings of the subsidiary since they were acquired. And that's it for my presentation. Thank you for watching.